China didn't fire a missile. It opened a bank. In just 60 days, Beijing slashed its U.S. Treasury holdings to $760 billion, imported 127 metric tons of gold, and expanded its financial reach with new outposts in Hong Kong and Singapore. While Washington moves to cut China off from World Bank funding, China is now writing its own loans, on its own terms, and countries are lining up to take the deal. This isn't diplomacy. It's the quiet launch of a financial empire, and the U.S. may have just triggered its own unraveling. In April 2025, Treasury Secretary Scott Bessent discreetly urged the Asian Development Bank to freeze new loans to China, aiming to choke off Beijing's access to multilateral capital. But China didn't respond with protest. It responded with expansion. Within weeks, the Asian Infrastructure Investment Bank, AIB, China's own multilateral lender, announced new branches in Hong Kong and Singapore, two of Asia's most powerful financial hubs. With $57.4 billion in assets in 38 member countries, the AIB's message was clear. This is not retreat, it's an offensive. According to Bloomberg, China has already deployed more than $52 billion through the AIB, primarily into energy and transport, the very sectors once dominated by Western lenders. As Washington pressures the IMF and World Bank to isolate China, Beijing is reshaping the entire financial landscape, funneling capital that flows straight back to Chinese firms and industries. If the U.S. aimed to box China out, it may have simply forced it to build a bigger ring. Bessent's broader strategy, to condition U.S. support for global institutions on reforms aimed at curbing China's influence, may have instead highlighted America's own limitations. At the IMF's April meeting, Bessent blasted what he called mission creep in multilateral lending and demanded China be graduated from developing nation status. But the AIIB continues to attract key U.S. allies. Germany and the U.K. remain full members, quietly undercutting Washington's efforts. Reuters reported that Bessent tied a $4 billion U.S. contribution to the World Bank's Poorest Country Fund directly to China-focused reforms, effectively turning development funds into political bargaining chips. Beijing, however, is under no such pressure. Flush with a $1 trillion trade surplus, China isn't waiting for permission. It's issuing loans with fewer conditions and faster outcomes. And that raises a difficult question. If America's diplomacy comes with caveats, while China's comes with cranes and engineers, who looks like the more reliable partner? The AIIB isn't catching up. It's building a parallel global financial network, one where China sets the priorities and calls the shots. According to its 2024 disclosures, the AIIB has already funded 45 energy sector projects, making up more than a third of its loan book. Many are in Belt and Road countries, blurring the lines between China's infrastructure diplomacy and its financial expansion. The U.S., notably, holds no voting power. China, by contrast, controls 26.6%, enough to unilaterally veto any strategic decision. It's a mirror of America's dominance at the IMF, flipped in China's favor. Now, China's capital is directing the global development agenda, especially across Asia and the Middle East. The Wall Street Journal recently reported that the AIIB has begun encouraging borrowers to accept loans in yuan, a quiet but strategic challenge to the dollar's dominance. Every project repaid in Chinese currency further normalizes the yuan and chips away at the dollar's global monopoly. This isn't just infrastructure financing. It's a blueprint for influence. Take Uzbekistan's recent $75 million AIIB loan for a renewable energy project. On the surface, it looked like green progress. But dig deeper, and the mechanics tell a different story. The turbines? Supplied by Vision. The batteries? Likely from KTL or BYD. Construction? Managed by Power China, a state-owned giant. According to a March 2025 project brief obtained by Nikkei Asia, over 90% of expenditures cycle back into Chinese companies. It's not aid, it's industrial recycling. And it pays off on two fronts. Foreign influence abroad, domestic supply chain string at home. AIIB loans increasingly resemble vendor financing packages, bundled deals that push China's manufacturing base outward. In contrast, Western development banks often require open bidding and local sourcing, which slows timelines and reduces returns. So while the U.S. warns of debt trap diplomacy, Beijing quietly fosters loyalty to interdependence. And the more nations plug into China's loop, the harder it becomes to unplug. Washington hoped that excluding China from the Bretton Woods system would stall its global ambitions. Instead, it left a vacuum, and Beijing moved in fast. At the ASEAN GCC summit in May 2025, China proposed a new economic zone linking Southeast Asia and the Gulf, backed by AIB funding. Days later, the bank announced it would boost lending in local currencies, especially the yuan, to reduce reliance on the dollar. According to Financial Times, yuan-based cross-border settlements surged 35% in Q1 2025, the fastest quarterly growth in nearly a decade. This isn't theory, it's supply chains. Solar plants in Indonesia, hydropower in Central Asia, fiber optic networks through Africa, all built, financed, and anchored by Beijing. While Washington talks reform, China lays concrete. One turbine, one port, one repayment cycle at a time. So the question is no longer whether China is catching up. It's whether the U.S. even realizes the rules of the game have changed. According to SWIFT data, yuan-based international payments surged by 35% in Q1 2025 year over year, marking the sharpest rise since 2016. It's a sign that China is doing more than lending. It's rewiring the global economy, and the tools Washington once relied on may no longer fit the task. The Asian Infrastructure Investment Bank, backed by Beijing, has quietly begun issuing loans in local currencies across Asia and Africa, prompting central banks from Indonesia to Nigeria to increase their renminbi reserves, according to Reuters. At the same time, China's central bank has cut its U.S. Treasury holdings to just $760 billion, down from over $1.1 trillion 5 years ago, and raised its official gold reserves for the 18th consecutive month. In April alone, China imported 127.5 metric tons of gold, despite bullion prices hitting a record high above $3,500 per ounce, according to the World Gold Council. But this isn't simple hedging, it's strategic insulation. With every renminbi-denominated loan and every ton of gold locked in vaults, Beijing is building a financial firewall against dollar risk. But the bigger question is, what happens when borrowers stop treating the yuan as a hedge and start using out of habit? Washington still holds institutional power, but its influence is slipping in rooms it no longer controls. While the U.S. pressures the IMF to scrutinize China's opaque currency policies, as Treasury Secretary Scott Bessent demanded in April, Beijing is expanding its financial footprint through institutions the U.S. doesn't even belong to. Take the AIB. China holds a 26.6% voting stake. The U.S. holds 0. Projects are scaling fast, from ports in Kenya to rail lines in Uzbekistan, with no requirement to follow Western lending norms. Meanwhile, U.S. allies like Germany, France, and UK remain active AIB members, complicating Washington's narrative of a unified Western front. Even World Bank President Ajay Banga admitted in May that U.S.-led reforms can't move forward without serious buy-in from other major economies. The irony? As Washington demands stricter multilateral compliance, some of its closest allies are quietly adopting Beijing's more bilateral and more pragmatic model. So, if the U.S. still sees itself as a sheriff, what does that make the rest of the posse? Walk into any shopping district in Shanghai or Shenzhen, and you won't find lines at banks, but at gold dealers. The People's Bank of China has raised commercial gold import quotas twice in 2025 alone, triggering a record wave of consumer and institutional buying. For the first time in 2 decades, Chinese gold demand has outpaced India's. Behind this surge is more than cultural affinity. It's capital flight in plain sight. Real estate is volatile. Stocks are tightly regulated. Foreign bonds are politically risky. For China's growing middle class, gold remains the safest store of value. In April, the Shanghai Gold Exchange recorded 194.5 metric tons in withdrawals, the highest monthly total since 2021. Meanwhile, China's 4 major state-owned banks, ICBC, BXC, CCB, and ABC, are actively promoting physical gold accounts to retail clients. That's not speculation. It's conversion. And when savings exit dollars and enter vaults, they don't just leave a hole. They sent a message. Consider a recent $100 million AIB loan to build a solar grid in Pakistan. On paper, it's development finance. But the panels come from Longis Solar, the inverters from SunGrow, the project management from Power China. According to AIB disclosures and contract data tracked by Infrastructure Journal, over 84% of loan proceeds cycle back into Chinese firms. The borrower gets electricity and debt. China gets revenue, influence, and permanent market access. This model doesn't replicate U.S. foreign aid. It replaces it. American loans often come tied to democratic reforms or IMF conditions. Chinese financing comes with shovels, cranes, and contracts, fast, predictable, and with fewer strings attached. Yet, critics warn that speed comes at cost. Strategic dependency. Just look at Sri Lanka's 2017 Hambantota port deal. When the government defaulted, it surrendered control of the port for 99 years. The point isn't whether Chinese loans work. It's who they end up working for. Because when infrastructure comes bundled with leverage, the blueprint starts to look less like development and more like a chessboard. Here's the moment of clarity. While Washington builds walls with tariffs and policy demands, Beijing is building systems with cranes, banks, and bullion. The U.S. may still write the rules of the IMF, but China is quietly drafting the contracts the rest of the world is signing. And those contracts are reshaping the flow of the global economy, from currencies to commodities, from ports to power grids. So if China is already replacing U.S. loans, rewriting trade in its own currency, and shielding itself with gold, what happens if it makes its next move? What if China starts pricing oil in yuan? Or worse, from Washington's perspective, what if other countries agree? Let us know your thoughts in the comments. Is this economic warfare or just a long overdue correction? And if you're still watching, stay tuned. Because China's next financial weapon might not be a bank. It might be a blockchain.